Tom's Mom's Corporation decided at the beginning of 2020 to change from the declining balance method of depreciating its capital assets to the straight line method because the straight line method better represents the pattern of benefits provided by the capital assets. For years prior to 2020, total depreciation expense under the two methods was as follows: declining balance 225,000 and straight line 105,000. The tax rate is 30%. Tom's Mom's follows ASPE and the taxes payable method of accounting for income taxes. Prepare Tom's Mom's 2020 journal entry, if any, to record the change in estimate. So what do you think? Are we going to record this retroactively or prospectively? Now, looking at the question here, it's telling us that the reason that they're changing between these two methods is to better mirror the pattern of benefit that they are receiving from the capital assets. And this means that this is a change in accounting estimate. And changes in accounting estimates are accounted for prospectively, meaning that no change is required. No retroactive accounting entry is required, and Tom's Mom can begin accounting for this change in accounting estimate at the beginning of 2020. So that question was relatively simple.